Hi everyone, it's Don. It is Monday, April 7th at about 11:15. Folks, I just wanted to put out a word of caution here, especially to our members and active traders alike. The volatility in the markets is extreme, okay, is extreme. And when volatility gets like this, the difference between the bid and the ask can really widen out, becoming virtually illiquid, right? One of the things that we teach in the first day of Q School is how important liquidity is to us as active traders. That is the difference between the bid and the ask. When that widens out, the risk really picks up and the cost also to trade. So to give you an idea, what we do in that environment is immediately reduce the leverage and reduce your exposure in the amount of trading. This morning, in the span of minutes, I put on two micro NQs. And within minutes, from a dollar standpoint, that went from a few $100s, which would be a few $1,000, or it would be about $1,000. It went to $5,000. 5,000. Two micro contracts within minutes. Now they had stops, dynamic stops. We ended up netting probably about 3, because in the span of just minutes, it came back. In fact, it virtually came almost all the way back. I look at the Twitter sphere, and what do we see? We see David Portnoy. We see the Twitter sphere buying and selling micro contracts and everything else based on headlines and false headlines. It reminds me of the people who go out and go windsurfing when we have a Cat 3 or Cat 5 hurricane bearing down on us. It's ludicrous. So don't fall for the trap. Don't fall for the headlines. Don't get sucked in. Here, our trading is done. We did a little bit and we get out. The volatility will come back in. Those people who are windsurfing during this, they will drown. They will do whatever it is they do and go away and go back to betting on basketball or hockey or football or whatever. But that is not, and this is not, what we do day in and day out. Our trading actually helps with the liquidity to help stabilize markets 99% of the time. But in the environment we're in, which is less than, probably 0.1%, it's probably wise and prudent to at minimum, reduce your leverage, slow your trading down, widen it out a little bit if you do any at all, and or use options. But with this high implied volatility, the buying of options is going to be very expensive. And that's also going to be problematic for hedge funds. So selling put spreads down at extreme levels and selling call spreads at high levels would be a wonderful way to go. But that is for folks who have some option savviness. We wish everyone the best. Just a word of caution, though. The markets are right now rather illiquid and unstable. So go with caution. Good luck, everybody.